In November of 2000, we entered a new cycle for the investment world. And the investment world only really moves, well, let me be clear about this. The investment world only moves through two different cycles. One cycle is where people pay more and more for $1 of annual lifetime income. The way that the stock market looks at that is a price to earnings ratio, specifically an as reported price to earnings ratio. And when that as reported price to earnings ratio goes up over time, for example, say from 6 to 45, that is a very certain market. That's a very certain cycle that the entire investment world moves through. But then it reverses itself, and people say, no, I'm not going to pay $45 for $1 of lifetime annual income, which again is the equivalent of paying a PE ratio of 45. And then what they do is they say, no, I'm not going to pay $45. I'm going to pay $40 PE ratio, then a 35, then a 30, then a 25, then a 20. And as that as reported PE ratio is falling and the dividend yield is rising, that's a completely different type of stock market. Now, I have many names for it. I can call it a uncertain cycle when that price to earnings ratio is falling because the level of uncertainty increases. It's also a contraction cycle because that as reported PE ratio is contracting over time. And I've also called it a physical cycle because physical assets beat everything over that time period. And there's a very, very specific type of physical asset that beats everything. And so the entire world's been in this uncertainty cycle since November of 2000. And this is important. This is actually the foundation of investing because when we are in an uncertainty cycle, then uncertain things are going to happen. For example, if we were in the Y2K, if you guys remember back to Y2K when all the computers need to be changed and the world was going to end and the stock market was going to collapse, well, that actually happened in a certainty cycle. When long-term capital management, a gigantic hedge fund, imploded, that happened in a certainty cycle. When the savings and loan debacle happened in the late 80s, that happened in a certainty cycle. And so the cycle that we're in matters most because it determines how bad things can get. And so yesterday there was a vote, and this vote happened in an uncertainty cycle, and that's a little bit about what I want to talk to you about today. Hey everybody, this is RC Peck, and this is my weekend podcast. It's episode 337. Good to have you all here. And there was a vote that happened yesterday, and when votes happen in the cycle called of uncertainty, different things can happen. So the UK yesterday, they voted to see if they should stay in the European Union. Now they got entered into, or they voted into the EU in 1973. So they were in about 43 years. And right after they got into the EU in 1973, in 1975, the country voted whether they should stay in the EU or not. So a vote like this is not, there's no precedence to it. I mean, it has happened before. Back in 75, they voted to stay in, and yesterday they voted to leave. So the vote itself is not a big precedent. But what's so interesting to me about this is everything I was reading said it was tie, right? Like, man, it could go either way. This could go either way. This could go stay, or what they called remain in the EU, or it could go leave. But here's what's interesting. It didn't happen in a cycle of certainty. It happened 16 years into an uncertainty cycle, this contraction cycle. And when things happen in a contraction or uncertainty cycle, we're going to get a lot of quote unquote surprises. Like Bernie Sanders is a surprise. Donald Trump is a surprise. Surprises happen in uncertainty cycles. And that's why we see a lot of uncertainty because of what is actually going on with the price to earnings ratio of the S&P 500. And it's really what's underneath that. What's underneath that is people are saying, I'm not paying as much for one share of the S&P or one share of the FTSE, which is the UK stock exchange, or one share of the CAC 40, which is the French stock exchange. It's saying, I'm not going to pay as much. I'll pay a little bit less. I want it to be a better value because I need to pay down some debt. I need to clean up my financial house. And that takes an entire cycle to go through. On average, it's about 18 years. And it was just so interesting with the UK voting whether to leave or remain in the EU, because the quote-unquote experts said, yeah, they're going to stay. They weren't really looking at the data, and they didn't understand that we are in a uncertainty cycle right now. And so the vote came in late last night. I was watching it come in. And it was basically 52% said, let's leave the Union, and 48% said, let's stay in the European Union. And the market was not expecting this. Now, this actually should be a shock, and I want to show you why this should be a shock. If you look at this price chart right here, this is the FTSE. The FTSE is the UK stock exchange. It's kind of like the New York Stock Exchange. If you look at this price chart, this is 1 year of data for the UK stock market. And the blue line is a 70-day exponential moving average. So when you look at this, you can see things are already not doing well in the UK over the last 12 months. The blue line is falling, and the squiggly line that's going up or down, which sometimes is green when it goes up, and when it falls, it's red. That is showing, things aren't going that well in the UK. Now, over here to the right, if you can see this, over here on the right side of the screen, that's when the vote came in. This red line right here is the vote coming in as we want to leave the European Union. Even though we've been in for 43 years, it's time we take back control of our lives. We take back control of our immigration. We take back control of our country. We don't want the people, the unelected people in Brussels telling us UKers, right? That's Scottish, British, Welsh, and Northern Ireland people. We don't want people in Brussels telling us what to do anymore. People want back their control. And this is what happens in an uncertainty cycle or a contraction cycle. People are saying, I want control back over my life. And so they don't pay $45 for $1 of income from the S&P 500. Today it's around $21. They're saying, enough. I want control back over my future. And that's what the vote was for yesterday. It was a vote saying we want control back over our future. Now, I show you this price chart because when you look at this price chart, here's the line here of the vote coming in. But you could look at this price chart and go, I don't know, down? Not looking good, but certainly not positive. Confusion maybe, but nothing else. The vote comes in, and here it's a red line down, and the blue line's been going up since the end of February. So the blue line, which is the 70-day exponential moving average, it's been going up for 4 months, and it's flat right here the last 2 months. Whenever you see a flat line, you have uncertainty. And so going into it, it was fully the stock market, the price charts of the FTSE fully said, I don't know. I don't know. I don't know. And yet experts said, oh no, they're going to stay. They went against the data. Now, I wanted to show you the price chart just to show you how looking at price charts can greatly help. But the other reason I wanted to show you price charts is I have deleted a lot of the noise. You see this FTSE, that's FTSE, without noise. So I'm not showing you how high the price went in a day, how low it went in a day. I'm just showing you where it closed for that trading day. And all you see here is where it closed. It opened up here for the trading day. It closed down here. This happened Thursday in the UK. So this is a lot of noise that's deleted because we don't see the open, high, low, and close of each day. Now I want to zoom into this 3 months here because this 3 months is really sideways. I just want to zoom into this and show you if we were looking at an open, a high, and a low, and a close. So I've zoomed into the last 3 months of the UK Stock Exchange, and now it has all the noise. Right, so you see this right here. On this day in May, the FTSE went as low as down here and then went back up. But really, it opened right there and it closed right there. Now, if you go over here to this huge red bar, and just so you know, from the very top to the very bottom, that's an 8.7% move. It opened here. It went all the way down here. This is the price of the UK Stock Exchange yesterday. And then it finally closed right here. That's an 8.7% move from top to bottom, but from where it opened to where it closed, it was a 3% move. Still a very scary move, but if you look at this screen here, or definitely if I go back to this, yeah, this thing's been moving a lot. It moves 3% down, 4% down. It's moving up, it's moving down, it's moving up. This is what it's doing now. Like if I showed you this price chart, you might not know where the vote was. You might say, oh, the vote was right here, or the vote was here, or maybe it was right here, or maybe the vote was here. But the vote was actually right here. And so price charts have a way of really smoothing out and eliminating the noise. And that's one of the things I teach with my research, is to show people how to eliminate noise, because people are inundated with noise from the internets and the Facebooks and the LinkedIns and the blogs and the cable news and the pick of the month, pick of the week newsletter services. They are inundated with noise, and it's hurting their future. And this is just a perfect example of how to eliminate noise. So what's the takeaway? We are in an uncertainty cycle. We entered into it in November of 2000. Now, if you go look up the term uncertainty cycle or contraction cycle, I also call it peak gold cycle, and I call it physical cycle. Yes, I know, I like to name things, and they're all right. You have to understand the foundation. We are in that uncertainty cycle, and we're not out of it yet. It's different from a certainty cycle. Now, we are in a certainty cycle, or you could call that an expansion cycle, because the PE ratio is expanding, but it's very different. Stocks don't do best. In fact, there's other assets that do much better than stocks in a uncertainty cycle. And I was teaching that this week in the Peak Gold training that I put on Tuesday. When the investment world, and this is just not a US thing, when the investment world is going through one of these cycles, whether you want to call it an uncertainty cycle or a contraction cycle, but when it's going through it, it's kind of like springtime, right? So I don't know if you know this or not, but meteorologists have a very difficult time giving forecasts in the spring. Man, they can get the other 3 seasons of the year really dialed in. They're about 95% right when they tell you what's going to happen in the 5 days coming. But when spring happens, it is just crazy and unpredictable. And what's supposed to rain, you get sun, or you get cloudiness instead of sun. It's very, very unpredictable in springtime. Those 3 months are very confusing to meteorologists. And we're in one of those springtime periods right now. But it's not lasting on average 3 months. It lasts on average about 18 years. So we're in that springtime-like phase of the stock market right now, of the investment world right now. And that's why people are having these kind of painful experiences with their money. What you are going to want to know, what you'll probably want to know is, well, RC, if these cycles have been happening, which they have been happening for 120 years, then just tell me what works best. Where does my money move best? Right? And maybe I shouldn't align my money to my age or my self-described risk tolerance. I should align it to the cycle. I should align it to what the market is doing, and not necessarily how old I am. Because you know what? The market doesn't really care how old you are. Yes, your age matters. It is part of the recipe. It's one of the ingredients in the recipe. But it's not the 5 scoops of flour. It's like the 1/4 teaspoon of oil. You need it to make sure the cake tastes good, but it's not the main ingredient. The industrial investment complex, Wall Street, big box, boutique, independent, advisors, right? Even disruptors, even people coming out of Silicon Valley saying, we're gonna change the way that people invest. They don't even get this right, because no one actually sits down and looks at 120 years of data. It's knowing what cycle we're in. That's what's most important. Knowing what cycle we're in and knowing what grows best. Hey guys, this is just another step in helping you protect your portfolio and protect your future. Until next time, this is RC Peck. Hey everybody, it's RC here. I put on a training this week called Peak Gold, which I go into these cycles. And if you haven't seen it, I guess you kind of lose out on it. But what I wanted to say is what it teaches these cycles. It shows you where to put your money. The safest place you can put your money is the thing that is cycling up, that is trending up. That is the safest place you can put your money, because it protects you in an absolute term, and it also protects your purchasing power. That's what does best. And there was a Peak Gold training that gave a pretty amazing offer at the end to not only give access to show you exactly where to put your money, how to position your money. If you are certain personalities, I show you exactly how to do that. I will tell you when to get out. I will tell you when to get in. It's a strategy that I call LTech Gold, but it's also LTech Bond because there's two assets that do really well in these uncertainty cycles or contraction cycles. And I will be sending out an email just to give you access just to the offer because it's a pretty unique offer that is not done out there. Many times when people get access to precious metal mining newsletters, they pay $2,000 to $5,000 a year for those services. The problem is they keep giving you those pick of the week, pick of the month newsletter ticker symbols, even if you should be out of the gold sector. So I want you to just see what that offers, just so you can see what a very straightforward offer looks like. And I do something that's pretty cool in that I don't think anyone else does anywhere in the world, and I have a no upsell policy. So once you get my research at that level, you get all of my research, everything I've done in the past and will do in the future. You get all of it as long as you stay current with your annual subscription. You'll never be upsold another piece of research from me. So I'll make sure you see just what that offers. If nothing else, just know that, hey, things really are different over at Fearless Wealth and what RC does. You guys have a great weekend. I appreciate you being here, and I'll speak to you soon.